Let's do a quick experiment today. I want you to open up your phone, go to TikTok or Instagram, and just scroll the financial tags for about 60 seconds. I guarantee you will see him. It's a 19-year-old kid sitting on the hood of a rented neon green Lamborghini in Dubai, aggressively pointing a camera at his face and telling you that the traditional 9-to-5 job is a complete scam. He stares directly into the lens and says that for the incredibly low price of a $500 evaluation fee, a proprietary trading firm will hand you $100,000 of their own capital to day trade with. On the surface, this sounds absolutely incredible. It's marketed as the ultimate democratization of Wall Street. The narrative is that the little guy finally has the keys to the castle and you don't need a trust fund to get rich anymore. But let's cut the garbage today. We need to tear down this beautifully crafted facade. This entire ecosystem, this massive $12 billion shadow economy, is a mathematically rigged casino, and you are not the player. You are the product. I love using absurd comparisons to explain financial concepts, so let's put it this way. If the modern proprietary trading industry were a Tinder date, it wouldn't just be a guy lying about his height, it would be a guy who maxes out your credit card while you're in the bathroom and then comes back to the table and tells you it's an investment in your shared future. It is a highly predatory, brilliant illusion. The mainstream financial media loves misdirection. They want you looking at the Federal Reserve or whoever's in the Oval Office, or the latest flashy AI stock bubble as the biggest risks to your financial well-being. But the real threat to everyday retail investors, specifically Gen Z, is quietly draining their bank accounts through simulated trading challenges. Today, we are exposing the lie. We are going to break down exactly how these shadow firms use a terrifying mathematical certainty to guarantee your failure, and how they take your hard-earned evaluation fees to pay for their Lamborghinis. Let's dive in. To understand how this $12 billion lie is currently getting away with siphoning money from retail investors, we cannot just look at the present. We have to hit the rewind button, zoom out, and look at the historical context to explain exactly how we got here. Because predatory financial mechanisms didn't just wake up yesterday and decide to start manipulating economic reality. The desire to exploit retail greed is a highly calculated playbook developed over decades of speculative manias. Let's rewind back to the late 1990s and look at the dot-com bubble to understand the origins of retail day trading. Back then, everyday people were completely obsessed with the internet, believing it was an entirely new paradigm that defied all historical valuation metrics. You had doctors, lawyers, and mechanics literally quitting their stable full-time jobs to sit at bulky desktop computers and day trade tech companies that had zero revenue and zero profits. The mainstream narrative was that you simply could not lose. But eventually, as all debt-fueled bubbles do, it violently collapsed. The everyday retail investor was absolutely crushed, and the system learned a very valuable lesson. Retail greed is one of the most easily exploited psychological forces on Earth. But the real turning point, the moment the system officially broke and the absolute gamification of finance became a permanent fixture, was much more recent. We have to look at the massive global liquidity injection that happened during the 2020 pandemic. You remember 2020, the entire global economy shut down. Traditional sports were completely canceled, meaning sports bettors had absolutely nothing to gamble on. Millions of people were trapped in their homes, staring at their screens, completely bored and severely financially anxious. At the exact same time, the government and central banks stepped in and pumped infinite liquidity into the system. Trillions of dollars in stimulus checks flooded directly into everyday retail investors. And what happened? A massive, unprecedented collision occurred. Zero-commission trading apps revolutionized the interface of investing, making it look and feel exactly like a mobile video game. Confetti literally exploded on your smartphone screen when you executed a trade. The traditional lines between investing, trading, and gambling were permanently erased. This era gave birth to a whole new culture of retail trading. It birthed the Discord degenerates and zero DTE options traders who literally lose their entire life savings gambling on ridiculous meme coins. It created a culture where holding a solid dividend-paying stock for 10 years was considered a boomer joke, and leveraging your rent money on a cryptocurrency with a picture of a dog on it was considered a legitimate financial strategy. But then, the pandemic ended. The stimulus checks finally dried up, and the central banks aggressively raised interest rates to fight off the inflation they created. The easy money completely disappeared. But the dopamine addiction that the gamified market had created in an entire generation of young people, that did not disappear. Gen Z was completely hooked on the adrenaline of the casino, but they no longer had the capital to play at the big tables. And this is the exact historical moment where the modern proprietary trading firms stepped out of the shadows. They looked at an entire generation of desperate, capital-starved, dopamine-addicted retail traders and said, "We have the perfect solution for you. You don't need your own money. Just prove you can trade and we will give you ours." They realized that as long as they could manipulate the structure of the game, they could farm these retail traders for endless evaluation fees. The goal was never to find profitable traders. The goal was simply to maintain the statistical illusion of opportunity. So, how exactly does this illusion work on a day-to-day basis? How do these firms fake the opportunity while quietly siphoning millions of dollars out of the pockets of Gen Z? To break down this complex financial trap, we need to look at the exact mechanics of the industry through the eyes of the people it exploits. Let's use a fictional character to explain the mechanics. Let's meet Tyler. Tyler is a hardworking, everyday 20-year-old kid. Tyler wakes up every morning, pours an energy drink, opens up TikTok, and tries his absolute best to find a way out of the traditional rat race. Tyler doesn't want to work a minimum wage job for 40 years. He sees the finance bros pacing around their high-rise offices in Patagonia vests, aggressively packing Zyn pouches into their upper lips and making millions off complex macro trades. Tyler wants to be them. He sits in his bedroom, hanging out with other Discord degenerates, trying to learn how to trade foreign exchange markets and stock indices. But Tyler has a massive problem. He only has $500 to his name. Even if Tyler is a phenomenal trader and makes a 20% return in a year, 20% of $500 is only $100. It is literally impossible to buy a Lamborghini or achieve any semblance of financial freedom with that little capital. Then, Tyler sees an advertisement for a modern prop firm. The firm tells him, "Tyler, if you pay us a $500 evaluation fee and you pass our simulated trading challenge, we will give you a funded account with $100,000 of real capital. You keep 80% of the profits." Tyler is completely mesmerized. He hands over his $500, thinking he has just bought a lottery ticket where his own skill is the only determining factor. But this is where the massive statistical illusion comes into play. I want you to pay very close attention to the word simulated. When Tyler pays his evaluation fee, he is placed into phase 1 of the challenge. The prop firm gives him a set of incredibly strict rules. Rule number 1, Tyler must make a 10% profit on his imaginary $100,000 account within 30 days. Rule number 2, and this is the absolute deadly one, Tyler cannot ever lose more than 5% of his account balance in a single day, or 10% overall. Let's break down why these specific numbers are a psychological and mathematical trap. To make a 10% profit in just 30 days, Tyler is forced to take massive, highly leveraged risks. He cannot trade slowly, methodically, or safely. The time limit forces him to gamble. But the moment he takes a massive risk, he is statistically guaranteed to experience a normal market fluctuation. Because his maximum allowable loss is so incredibly tight, the slightest pullback in the market will trigger a violation of the rules. Tyler takes a trade. The market naturally breathes and pulls back a few points before heading in his intended direction. But because Tyler is heavily leveraged to hit that aggressive profit target, his account momentarily dips past the 5% daily loss limit. Instantly, the screen goes red. The simulation is locked. Tyler has failed the challenge. His $500 is gone, entirely absorbed by the prop firm. But the psychological trap is that Tyler doesn't blame the firm. The firm shows him the data and says, "Look, Tyler, you broke the rules. You lack discipline. Try again." Tyler truly believes he was just one trade away from $100,000. So he scrapes together another $500 from his part-time job, buys another evaluation, and tries again. He is caught in an endless, vicious loop of failure. And here is the absolute most sickening part of the entire charade. Tyler is not actually interacting with the global financial markets. His trades are never hitting a live exchange. The prop firm operates entirely internally, utilizing simulated trading challenges. They are running a localized demo account server. Tyler is quite literally playing a highly stressful, beautifully designed video game. The prop firm isn't trading foreign currencies, they aren't trading tech stocks, and they certainly aren't trading the yen carry trade. They are trading Tyler. They are farming Gen Z for $500 evaluation fees. The $12 billion industry is not built on successful trading. It is built entirely on the massive volume of retail failure. The prop firm is acting exactly like a casino house, creating a closed-loop system where the everyday retail investor is completely left behind, gaslit by a marketing apparatus that tells them financial freedom is just one more evaluation fee away. All right, we have officially reached the climax of this entire charade. We've established that Tyler is trapped in an endless loop of buying simulated trading evaluations, desperately trying to hit aggressive profit targets while dodging impossibly tight drawdown limits, all while the firm quietly pockets his hard-earned fees. But why does this massive, glaring disconnect keep happening? Why do millions of young people genuinely believe they can beat this system? And why is the official failure rate of these prop firms hovering around 95 to 98%? This brings us to the uncomfortable truth. This is the systemic flaw that nobody on traditional financial media or TikTok will ever admit to you. There is a deep, fundamental mathematical law that governs how these modern prop trading firms operate. And this video uses a brilliant mathematical concept called gambler's ruin to explain exactly how they fake the opportunity. By diving into the mathematical concept of gambler's ruin, we can mathematically prove that these challenges are built entirely on the statistical certainty that you will eventually hit a bad streak and lose everything, funding the firm's profits with your inevitable failure. Let me break down gambler's ruin for you in the simplest, most undeniable way possible. The theory of gambler's ruin states a very simple, unavoidable mathematical rule. If a gambler playing a fair game of chance with a limited bankroll continues to play indefinitely against an opponent with an infinite bankroll, the gambler will eventually go completely broke with a statistical probability of 100%. Imagine you are flipping a perfectly fair coin with a billionaire. Heads, you win $1. Tails, you lose $1. Because the coin is fair, over 10 flips, you might be up $2 or down $2. But what happens if you flip that coin 10,000 times or 1,000,000 times? Because of mathematical variance, eventually you will hit an incredibly long, statistically brutal streak of tails. You might flip tails 20 times in a row. Because your bankroll is limited, that streak of bad luck will eventually wipe your account down to exactly 0. The billionaire, having infinite wealth, can absorb any streak of bad luck and simply wait for you to go broke. Now, I want you to apply the undeniable law of gambler's ruin directly to the proprietary trading industry. When you buy a prop firm challenge, you are playing a game with a heavily restricted bankroll. That incredibly tight 5% daily drawdown limit they give you, that is your finite bankroll. The prop firm, collecting millions in evaluation fees every single month, is the opponent with the infinite bankroll. But the situation is actually much worse than flipping a fair coin. Trading the financial markets is not a fair game. You are battling against massive institutional algorithms, spread fees, slippage, and completely unpredictable macroeconomic news events. The game has a negative expected value built right into the structure. The prop firms completely understand gambler's ruin. They employ mathematicians and actuaries to precisely design these evaluations. They know that even if Tyler is an exceptional trader with a proven, highly profitable strategy, he is a human being dealing with variance. It is a statistical certainty that eventually Tyler's strategy will experience a totally normal, expected streak of losing trades. If Tyler was trading his own capital over a 5-year horizon, he could simply reduce his position sizing, absorb the string of losses, and wait for his strategy to become profitable again. But the prop firm does not give him 5 years. and they do not give him room to breathe. They set the drawdown limits exactly at the point where natural market variance is mathematically guaranteed to hit it. They don't need you to be a bad trader to take your money. They just need you to keep trading until the mathematical certainty of variance triggers a rule violation. The moment you hit that inevitable streak of bad luck, the simulation locks you out, the firm keeps your entry fee, and you are financially ruined. This is exactly why the idea of getting funded is a highly calculated statistical illusion designed to protect the people at the absolute top. The firm is optimizing purely for failure. They do not care if you have spent years studying charts, and they do not care if you have completely mastered technical analysis, because you are playing a game where your failure is a mathematical guarantee. They just sit back and let the law of gambler's ruin do all the heavy lifting. The system is fundamentally broken, and you just have to accept it. The people running these massive, unregulated prop firms know exactly what they are doing. They are actively manipulating these incredibly complex psychological mechanics to ensure the liquidity never ever stops flowing from your bank account to theirs. They watch an entire generation of retail traders quietly collapse under the weight of these impossible rules, and they use that exact same evaluation revenue to buy more TikTok ads and lease more Lamborghinis to trap the next wave of victims. They have literally turned your desire for financial independence into a measurable, mathematically certain asset class. The prop firm isn't funding traders, they are actively farming them. So what is the actual endgame here? We are looking at a broader macroeconomic landscape where the traditional avenues to wealth feel completely out of reach for a young generation. Housing is completely unaffordable, inflation is sticky, and the stock market feels heavily manipulated by institutional players. Because of this, Gen Z is turning to the digital casino out of pure desperation. But these proprietary trading firms aren't throwing retail investors a lifeline, they are handing them a $12 billion anchor. We are operating in a highly toxic, entirely unregulated environment, where these companies are essentially running massive digital casinos, disguising their gambling operations behind the thin, plausible veil of financial education and trading discipline. It is a mathematically rigged system headed for severe turbulence. I want to hear directly from you on this, because I know a massive portion of you watching have either tried these prop firm challenges yourselves or know a friend who is currently trapped in the evaluation loop. Head down to the comments right now and tell me, do you think regulators are ever going to step in and shut down these simulated prop firms? Or is this mathematically rigged casino just a permanent new fixture of the digital economy? Let me know. I read every single comment, and I want to hear your real, unfiltered experiences with these impossible drawdown limits. If you are completely exhausted by the endless stream of fake Lamborghinis, toxic Discord trading gurus, and the absolute garbage being sold to you as financial education on social media, hit that subscribe button right now. You are never going to see this breakdown of gambler's ruin on CNBC or Bloomberg because the traditional networks are too busy hyping up the next bubble to care about the $12 billion being actively siphoned out of retail pockets. We are here to act as an actual watchdog. We are going to keep tearing down these illusions, exposing the brilliant scams and shining a highly uncomfortable light on the rigged mechanics that are secretly driving your reality. Keep your capital safe. Don't let a simulated casino tell you you're a bad trader, and I'll see you in the next video.